welcome to the Deep Dive. We're here to unlock some really powerful, timeless wisdom from key sources, trying to give you that edge in, well, what feels like a pretty noisy world these days. Today, we are really digging deep into the foundations of financial thinking. Principles that, honestly, could change how you look at markets wherever you're coming from. Okay, so our main source is Benjamin Graham and David Dodd's huge 1934 work, Security Analysis. And look, it's more than just a book, isn't it? It's this fundamental blueprint. It shaped people like Warren Buffett, he famously called it his roadmap, and so many other successful investors. We're also going to look at some real-world examples that show how these ideas are still incredibly relevant.
Yeah, and to really get security analysis, you absolutely have to picture when it came out. I mean, 1934, the absolute pits of the Great Depression. The market was just decimated. Nobody trusted anything. Speculation had gone wild. Graham and Dodd, they wrote this as a direct response to all that chaos. It was meant to bring back some sanity, lay down clear rules, and offer a rational way to invest when, frankly, the world seemed completely irrational.
Right. And our mission here for you, the listener, is to kind of cut through all the density in these sources. We want to pull out the absolute key insights. We'll show you how Graham's ideas became the bedrock of value investing, sure, but also how they offer this timeless way of thinking that can protect you, empower you, really, in any market environment. So, okay, let's kick things off where Graham and Dodd did, with this really fundamental distinction. They drew a very clear line between an investment and, well, everything else. How did they define that investment, and why was making that distinction so critical back then?
That is absolutely the starting point.
Yeah.
So for Graham and Dodd, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate or satisfactory return. All three parts have to be there. Thorough analysis, safety of principal, satisfactory return. If you're missing any one of those,
Then it's not investing.
then it's speculation. Exactly. It doesn't matter if you made money on it later, by their definition. If the process wasn't sound, it was speculation. The core idea, I think, is that the method matters, not just the outcome. It forces you, the listener, to ask, am I making a calculated move here, or am I just, rolling the dice?
And that phrase, thorough analysis, sounds simple, but it implies a lot of discipline, doesn't it? What do they actually say about how to do that analysis? How do we get to solid ground?
Oh, they were very specific. You look at three things. One, past performance. Two, the company's present financial condition. These are your facts, right? Your history. But the third part, future prospects. That's where they urged extreme caution. Because forecasting the future, that's inherently speculative.
So rely on what you can actually verify.
Exactly. Anchor yourself in the facts. Not just rosy predictions or hopes. It forces a certain kind of, intellectual honesty about what's real versus what's just a guess.
Yeah, that makes sense. And this sort of skeptical fact-first approach, it leads us straight into the core ideas of value investing. Let's start with the big one, intrinsic value. We hear that line, price is what you pay, value is what you analyze. What exactly did Graham and Dodd mean by intrinsic value? Why is it so central?
Intrinsic value is, it's basically the true underlying worth of a business, separate from whatever the stock market says its price is on any given day. It's based on tangible things, its assets, its real earning power over time, its durability, not just market mood swings or the latest news hype.
Okay, so it's about the business itself.
Precisely. And think about Apple back in 2008. Financial crisis hits, the stock tanks along with everything else, panic everywhere. But if you looked past the price, if you did a Graham-style analysis, Apple's fundamentals were still incredibly strong. You had massive free cash flow, that amazing brand loyalty, the iPhone was taking off.
The underlying value was there, even if the price was down.
Exactly. The intrinsic value was way higher than the panic market price. And investors who saw that, who focused on the value, they saw returns of over 1,000% in the following decade. So the key insight, really, is that the market gets it wrong. A lot. And understanding intrinsic value gives you the power to use that irrationality to your advantage, instead of just getting swept up in it.
Okay, so you figure out the intrinsic value. Then Graham and Dodd bring in this idea of the margin of safety. I always think of it as like your safety net. How does that protect you?
It's exactly that, a safety net, a buffer.
Yeah.
The idea is simple. You only buy when the market price is significantly lower than your estimate of the intrinsic value. This gap, this discount, that's your margin of safety. It protects you if maybe your analysis wasn't perfect or if things get worse than you expected, which, let's face it, happens.
Right, reality bites sometimes.
It does. Look at Wells Fargo in 2009. Deep in the credit crisis, the stock was trading incredibly cheap, like below book value cheap. People were terrified of banks. But Wells Fargo, I mean, it had this century-long dividend history, a huge stable base of depositors. It had weathered storms before.
So the underlying business was still solid, despite the fear.
Right. And Warren Buffett, who's basically Mr. Graham disciple, he famously upped his stake right then. Why? He explicitly talked about the margin of safety he saw. The price was way below what he thought the enduring value was. So connecting it back, it's about humility. It's admitting you can't predict the future perfectly, so you build in protection against being wrong.
That makes a lot of sense. Now, another really key part of their analysis was this idea of earnings normalization. They really seem to dislike short-term thinking. Why is looking at earnings over, say, 7 or 10 years so important?
Oh, absolutely. It's the antidote to getting obsessed with the latest quarterly report. Business goes and cycles, booms, busts. Graham and Dodd said, look, take an average over several years, maybe 7 to 10 years, smooth out those peaks and valleys. That gives you a much better picture of the company's true, sustainable earning power.
Not just a snapshot in time.
Exactly. Think about GM's IPO in 2010 after the bankruptcy and restructuring.
Yeah.
Lots of optimism, very rosy projections for that first year back. But a Graham-style investor would say, hang on, let's look at their earnings before the crash. Let's consider the cyclical nature of the auto industry.
So they'd be more cautious than the hype suggested.
Much more cautious. They'd use those normalized, longer-term earnings figures to figure out a fair price, which likely meant they invested at better prices with less risk when that initial post-IPO enthusiasm eventually cooled off. The fundamental point is real earning power isn't just one good year. It's about consistency through the cycle.
And it wasn't just earnings they focused on, right? The balance sheet was huge for them, too. This asset analysis, really digging into working capital, tangible assets, it sounds almost forensic.
It really is. Graham saw the balance sheet as this bedrock source of value. What does the company actually own? He looked hard at things like net working capital, basically current assets like cash and inventory minus current liabilities, and tangible assets, the real physical stuff, not goodwill or brand value on the books.
And that led to this fascinating idea of net stocks.
Yeah, the nets. These are companies trading for less than their net current asset value. Essentially less than what you'd get if you liquidated all the current assets and paid off all the liabilities, like buying $1 for 50 cents.
Wow. Does that actually happen?
It used to happen more, but yeah. The classic example is the Sanborn Map Company back in 1959. Buffett found this company, bought a big chunk of it, about 35%. He paid $45 a share. Get this, the company held $65 per share just in bonds and securities on its balance sheet.
So the assets alone were worth far more than the stock price.
Way more. Even though the actual map-making business was declining, the value was sitting right there in the assets. It provided this enormous margin of safety. Buffett made a great return. It just highlights that sometimes the value isn't in future growth, it's in what the company already possesses.
That's incredible. Now, moving beyond the pure numbers, Graham and Dodd also stressed something called dividend integrity. They saw how a company paid dividends as a sign of, what? Financial health, management quality.
Both, really. It was a window into how management thought about shareholders and how disciplined they were with the company's cash. They were suspicious of companies that just hoarded earnings without having clear, productive ways to reinvest that money, or without returning it to the owners, the shareholders.
So a steady dividend was a good sign.
A steady, preferably growing dividend that was clearly supported by actual earnings. Yeah. That suggested good management, a solid business, respect for shareholders. On the flip side, cutting a dividend or funding risky expansions with lots of debt while paying little back to owners, those were potential red flags. It's about transparency and making sure management is actually creating value for the people who own the company, not just building their own empire.
Okay, so these principles give us a really strong framework. But Graham also knew things go wrong. He talked a lot about risk. Even with bonds, which people think of as safe, he stressed analyzing bond safety. What did that involve? What could go wrong there?
Yeah, even with fixed income, safety was number one. The analysis is all about the issuer's ability to actually make the payments consistently. You look at their earning stability, how much cash flow they generate relative to their debt payments, that's interest coverage, and you look at asset coverage, what backs the bonds if things go bad.
Right, and the Lehman Brothers example you mentioned earlier really drives this home, doesn't it?
Oh, absolutely. A stark lesson. Between 2006 and 2008, Lehman was issuing tons of bonds. Looked okay on the surface, maybe. But a careful Graham-style analyst would have seen major red flags flashing. Interest coverage was falling. Earnings weren't keeping pace with debt payments. They were relying heavily on these complex, hard-to-value, mark-to-model assets, and they were borrowing more and more short-term money.
Clear signs of trouble brewing.
Clear signs of unsustainable leverage and weakening asset quality. When the house of cards fell in 2008, bondholders lost massively. It just shows even in safer areas like bonds, you have to do the homework on solvency and quality. Rigorous analysis is key.
And it wasn't just the numbers. Graham was emphatic about management quality. He basically said a company's uninvestable if the people running it are, well, dishonest or incompetent.
Totally. This is where the soft stuff like trust and integrity becomes a hard financial reality. I mean, look at Enron in 2001. On paper, the financials looked amazing for a while. Growth was off the charts, driven by really complex accounting.
But it was too good to be true.
Way too good to be true. A deeper Graham-style look would have revealed huge red flags. Massive amounts of debt hidden off the balance sheet, strange gaps in cash flow, super aggressive ways of booking revenue. These weren't just accounting quirks, they were signs of potential deception and unsustainable practices, signals about management's integrity or lack thereof. And we know how that ended.
Complete collapse.
Exactly. The point is, brilliant numbers can't save you if the leadership is fundamentally flawed or untrustworthy.
Okay, one last area they touched on was special situations. Things like mergers, spin-offs, liquidations. Sounds complicated, but potentially rewarding.
Definitely complex, yeah. And not for everyone. Graham and Dodd recognized that because these situations are often messy and confusing, the market sometimes misprices them badly. For investors willing to do the really hard analytical work, there can be exceptional opportunities.
Like the Washington Post example.
That's a perfect one. Berkshire Hathaway's investment back in 1973. The newspaper industry, and the Post specifically, faced some legal challenges and general market panic. The stock got hammered. But Buffett, using his Graham training, looked past the noise. He analyzed the underlying value of the newspaper, its strong market position, its earning power. He realized the intrinsic value was vastly higher than the market cap.
So he bought when others were selling.
He bought a big chunk, about 10% at a huge discount. And that investment, held for decades, turned into literally billions of dollars in value for Berkshire. It just shows the power of applying that rigorous, value-based analysis to situations where emotion and complexity are clouding most people's judgment.
So, wow, we've covered a tremendous amount from security analysis in this deep dive. Bringing it all together, what are the big overarching philosophical takeaways for you, the listener? What does it all boil down to?
I think it boils down to a few core ideas. First, accept that markets are often irrational. Your job isn't to predict the irrationality, but to remain rational yourself. Second, forecasting the future is, well, mostly a fool's errand. Your best defense isn't prediction, it's preparation through solid analysis and that margin of safety.
Focus on what you can control.
Precisely. And third, investing isn't about being the smartest person in the room or outguessing everyone else minute by minute. It's about discipline. It's about staying within your circle of competence. Knowing what you truly understand, and crucially, having the humility to admit what you don't understand, which, raises that important question for you listening. What actually is your circle of competence, and are you disciplined enough to stay inside it?
We really have journeyed through the core wisdom of security analysis. And it's so clear, isn't it, that this isn't some book of hot tips or easy shortcuts.
No, not at all. It's offering something much deeper, much more valuable. A systematic framework for thinking about investment. It's a system that has proven its worth through crisis after crisis 1929, the dot-com crash in 2001, the global financial crisis in 2008, even the pandemic volatility in 2020. It doesn't just tell you what to buy. It fundamentally teaches you how to think, how to evaluate risk, how to protect yourself, how to maintain discipline when everyone else is losing their head.
It really fosters that disciplined, analytical mindset that works regardless of what the market's doing today or tomorrow.
Exactly. And Benjamin Graham himself summed it up perfectly. He said, the essence of investment management is the management of risks, not the management of returns.
Love that quote. Okay, so here's a final thought, something for you, our listener, to really chew on. How might applying these core Graham principles, that thorough analysis, that focus on real intrinsic value, always demanding that margin of safety, how might that not just change your financial decisions, but maybe even how you evaluate information and make decisions in other complex parts of your life? That kind of thinking, that's the stuff that really compounds over time.